Can the pace of IPOs coming to market continue like this, Jess?
We're an active manager in Airbnb. But let me make a couple of comments. One, the overall backdrop is the market is extremely liquid following the monetary policy that's being pursued by major central banks, UK, US, in face of the pandemic. But we do have the fact that software companies are trading at extraordinary valuations. You've got a number of them trading at 30 times revenues, which is quite something. If you look at these IPOs, one, they relative to the market caps of the companies, while they look big in terms of absolute size, relative to the market caps, many of them are not that big. And secondly, the allocations are pretty tightly managed. And then two other comments I would add is, I always think that you should look at the value of an IPO 90 days after it's originally priced as opposed to the first night. There's a lot of averaging going on between the initial, the people who realize the initial stock at the $68 level, and then where do they take it and what's their average price based on what they buy. And then finally, again, I do think you have to look 90 days out. These were tight allocations, but the market is definitely pretty hot. And you've got also the phenomenon going on in the SPAC market. So we are seeing the impact of extraordinary liquidity and people trying to find returns, and the fact that a lot of people believe that value is in software, and you cannot miss what's going on in that industry with companies trading at 30 times revenues.
I guess, Jess, all of those factors you're talking about, the gains in the IPO market that we mentioned at the top, it's also a sign of the two-tier economy that we're seeing, the two-tier world at the moment. Do you think all of that activity, and we saw this in your last results, justifies your strategy to have an investment bank as well as a typical retail commercial bank?
We set this strategy, as you know, 5 years ago, and to remain a bulge bracket investment bank, based in London, but with a significant presence in New York. For sure, this year, in the first 3 quarters, we demonstrated we gained market share each quarter. It's been driving the profitability of the bank. It's enabled us to strike our highest level of capital ever, the most liquidity the bank has ever had. And then it also enabled us to do, primarily in the UK, the right things we wanted to do in terms of vulnerable clients, small businesses, partnering with the government to try to keep the economy going in face of the pandemic. But it clearly underscored the value of having a diversified model. UK consumer banks, and we are one of the top 4, are going to have a challenge given what's going on in the UK, and having the balance of a very active investment bank has helped. The other thing I would say is 12 years ago, the central banks had to bail out the banks in the financial crisis. This time, the liquidity, the banks are in a much better position, in part because of what the regulators have done. But the liquidity injection that we're seeing from the central banks is, in a way, bailing out the buy side. It's pushing a huge amount of money into mutual funds, into pension funds, into insurance companies, and they are providing tremendous buying support for growth in the capital markets, and the intermediaries like Barclays are doing very well.
Shepard Smith here. Thanks for watching CNBC on YouTube.